Hello, very good evening to all of you. Today we will learn about the cost volume profit analysis. In each and every organization, the objective of the organization is maximization of profit and maximization of shareholders' wealth. Maximization of profit is now an outdated concept. Nowadays, the recent concept is maximization of shareholders' wealth. That is, one should think to distribute as much dividend as possible to the shareholders, as well as to increase the shareholders' wealth. So profit of the organization is determined by a number of factors. It's internal as well as external. One such factor is the sales revenue of the business. Because if the sales revenue will increase, obviously the profit of the organization will increase. If the sales decrease, obviously the profit of the organization will decrease. But the sales is itself based on other factors. There's a demand of the product, the competition, the fixed selling price, marketing strategy adopted by the management. These are the factors on which sales depends. The other important factor that determines the amount of profit is the cost of production. If the cost of production will increase, the profit will decrease. If the cost of production will decrease, the profit will increase, keeping the sales price constant. Again, the cost of production itself is affected by many factors. That is volume of production, product mix, capacity utilization, whether you are properly, efficiently and effectively utilizing the capacity or not, efficiency in production. So these factors is important or affect the cost of production. So though all these factors affect the profit earning capacity of a business, the special mention about the volume of output deserves to be mentioned in this regard. The volume of output. This is because volume of output changes more frequently and rapidly, and is not susceptible to management control. More than this, the profit is more closely related to volume rather than cost. This is because costs seldom vary in direct proportion to volume. Hence, small changes in the volume has a significant effect on profit. Whereas a change in other factors such as an order size or lot size will have significant effect on profit. However, it is the duty of the management to consider the cost and volume while planning the profit earning capacity of the business. On such technique, which is used by the management, is known as cost volume profit analysis. As the name suggests, cost volume profit analysis examines the relationship of cost and profit to the volume of the business with a view to maximize profits. Generally, break-even analysis is another name of cost volume profit analysis. In management accounting, the focus is on cost volume profit relationship. In other words, an attempt is made through cost volume profit analysis to measure the variations of cost with the change in the volume of production. The attempts to establish this relationship is known as cost volume profit analysis or break-even analysis. A break-even analysis refers to the point of activity where total revenue equals to total cost. At this break-even point, there is neither profit nor loss. Means at this point, profit is equal to zero. So this point of activity is known as break-even point or no profit, no loss point. Under this type of analysis, break-even point is calculated in units as well as in rupees. On this point, the manufacturer neither earns profit nor suffers any loss. At this stage, the firm is said to be break-even. Under break-even analysis, the contribution is just equal to the fixed cost. Contribution we refer as C and fixed cost as F. That is, C is equal to F. Below this point, the firm obviously suffers from loss, and above this point, the organization earns profit. So break-even point is the point of activity where total revenue and total expenses are equal. It is the point of zero profit and zero loss. Break-even analysis indicates at what level cost and revenue are in equilibrium. Now, we just think about the difference between break-even analysis and cost volume profit analysis. The study of cost volume profit analysis is frequently referred to as break-even analysis. Yet, in the opinion of some experts, there is slightly a fundamental differences between the two. According to them, profit begins to arise at any level of activity. There applies cost volume profit analysis. Cost volume profit relationship is defined as the area of interest within an organization of management and accountant in observing and controlling the relationship between prospective and actual manufacturing cost, both fixed and variable, rates of production and gross profit. Now, how you calculate break-even point, BEP? Break-even point we may calculate in terms of unit produced or in amount of sales. So break-even point we calculate in terms of unit as fixed cost over contribution. That is, contribution is equal to sales minus variable cost. We know well. Where F is fixed cost, S is variable, S is selling price per unit, V is variable cost per unit. So we can say break-even point in units as fixed cost divided by contribution per unit. And break-even point in rupees, or break-even point as fixed cost multiplied by selling price per unit. Selling price per unit, that is P. You can say selling price SP per unit divided by selling price minus per unit minus variable cost per unit. That is S minus V. Or you can say fixed cost divided by, we divide P by P, that is P by P is equal to 1 minus V over P. Or fixed cost divided by 1 minus V divided by P is, you can say, as S, that is selling price. So V is variable cost, S is sales revenues. Or you can say again break-even point in rupees, how we calculate, that is fixed cost divided by PV ratio, that is profit volume ratio. And profit volume ratio is what? Profit volume ratio is C by S contribution over sales multiplied by 100. That is, profit volume ratio is the relationship between contribution and sales. Now, what we say as the utility of break-even analysis. We know in the business, profit should be planned in a planned way rather than be left to chance. In this direction, break-even analysis is a useful technique. It helps in studying the interrelationship between cost, volume, and profits. It also helps in the determination of that volume of sales at which cost and revenues are equal. So the usefulness of break-even analysis, we can explain it in a different way. That is, this device provides basic information and facilities in augmenting the profit. It is a diagnostic tool which serves management in explaining to him the reason for increasing break-even point and falling profits. Break-even chart and profit volume graphs prepared as part of break-even analysis for studying the effect of changing profits, factors of profit. The problems of risk evaluation can be solved by considering the effects of the alternative actions on break-even point. Break-even analysis is also an important technique over the ratio analysis technique, as it provides invaluable information on many types of managerial decisions. The technique serves the management in many ways, like calculation of selling price per unit of a particular BEP, choosing the most profitable alternatives, determination of sales to offset price reduction, and so on and so forth. Break-even analysis is useful in controlling manufacturing expenses and profits. Now, if anyone will ask you what are the assumptions of break-even analysis. So this break-even analysis is based on certain assumptions. These assumptions are very rare to find in practice. The results derived on the basis of break-even analysis should be interpreted keeping these assumptions in mind. That is, there is no change in general price level. Selling price will not change with the volume changes. Now, cost of each product should be classified into two categories, fixed and variable cost. Variable cost varies proportionately with the volume of output changes. Volume of production does not affect the fixed cost. The sales mix remains constant in case of one product and in case of multiple products. And productivity per labor should remain constant. And plant capacity and efficiency remains unaffected. So these are the assumptions of break-even analysis. Now we should know something about the PV ratio, that is profit volume ratio, that we have already discussed right now. Profit volume ratio is also known as contribution ratio, as I told you. It refers the relationship between contribution and sales of the enterprise. That is, PV ratio is equal to C by S. This ratio is presented in percentage. It is often used as a guide to profitability of a business. Here it is very important to mention that the word profit does not mean profit but contribution, as the contribution is the excess of sales revenue over variable cost or marginal cost. So it is not affected by any fixed expenses. So mathematically we calculate profit volume ratio as contribution over sales, and contribution we can write as sales minus variable cost over sales multiplied by 100, and S minus B we can say contribution per unit divided by sales price, the selling price per unit. We can say profit volume ratio as change in profit divided by change in sales. Profit volume ratio we can write as fixed cost divided by BEP. So PV ratio, profit volume ratio, is equal to fixed cost divided by profit divided by margin of safety. And what is margin of safety? Margin of safety is total sale minus BP sale is your margin of safety. Now come to margin of safety. In management accounting, it is very essential to explain the concept of margin of safety. Otherwise, the break-even analysis would be incomplete. If the sales exceed the break-even points, either in revenue or in units, this difference is called MOS, that is margin of safety. I already told you margin of safety is equal to total sale minus BP sales, or margin of safety is equal to profit divided by PV ratio, or margin of safety you can say ratio is equal to margin of safety divided by sales multiplied by 100. So what are the significance of margin of safety? Margin of safety is an important symbol of business strength. Larger margin of safety indicates sound financial position. If margin of safety is low, it should be improved by taking some important steps, like by increasing level of production and sales, by increasing selling price per unit and reducing variable cost per unit. So in this way we can, like if you take the example suppose the total sale of a company in a particular period is 15,000 rupees and BP break-even point is 10,000 rupees. So the margin of safety is how much? Total sale is 15,000 minus BP sale is 10,000, so margin of safety is 5,000 rupees. In terms of percentage, it would be 5,000 divided by 15,000 multiplied by 100, that is 33.6%. 33%. That is 5,000 is 33%, 33.3% of 15,000. Is that clear? Now, what are the objective of cost volume profit analysis? The cost volume profit analysis appears to be useful principally as a technique for the study of problems encountered in business planning. As such, it is a tool used by those executives responsible for strategic planning and policy making. More specifically, the objective of cost volume profit analysis are to forecast the profit accurately, to facilitate in the preparation of flexible budgets, to evaluate the performance of the business. For evaluating the profit earned and cost increased, it is necessary to know the impact of cost on the changed volume of output. To enable management in determining the pricing policies, to enable the charging of overheads to cost of production at different levels of production operations. So these are the objectives of cost volume profit analysis. Now we can see the graphic methods of presenting CVP analysis, cost volume profit analysis. This method is preferred under two conditions: where a simple overview is sufficient, and second, to avoid detailed calculation involved under equation method. The procedures is involved under graphics method, that is vertical line. On the left side of the graph, draw a vertical line on the left side of the graph paper to show the cost and sales revenue. There is horizontal line to show the number of units in such a way it should intersect the vertical line at the point of 0. Fixed cost line, the line parallel to x-axis, is to be drawn to represent the fixed cost considering the units manufactured and fixed cost incurred. Next is total sales line. This line is drawn starting at the 0 point on the left hand corner and ending on the right hand side considering the sales revenue. Total cost line. This is the total of fixed and variable cost. This line is drawn starting at the y-axis fixed cost point and moving to the right considering the total cost. And BEP is the point where total cost line intersect the sales line. And in this way you just see, this is the graph. This is the graph. You see, on x-axis there is units of sales, and y-axis there is cost and sales, and from 0 there is total cost line from y-axis, and from 0 there is total sales line, and both total sales line and cost line is intersecting at the point. The point is known as break-even point. When you put perpendicular from break-even point on horizontal axis, x-axis, the point where it cuts, it is called BP sales. And from the sales point lines, when you put perpendicular on x-axis, where it cuts, so after break-even point and up to x, this is called margin of safety. You just see above x-axis, horizontal, there is one more vertical line that is called fixed cost line. So from fixed cost line to X point, this is fixed cost. Again, there is the cost line, and from cost line up to the fixed line, this is called variable cost. And when we add both, that is called total cost. And from cost line to sales line, the margin is called profit. And in total cost, when we add profit, that will give you revenues. And this is the total of CVP analysis. Thank you very much. So if you have any problem to understand this, I don't think there is any problem to understand this. It's easy, very easy. And this graphical representation makes you more comfortable to understand this CVP analysis. But even then, if there is any problem, you can write your comment in the comment box of Facebook or YouTube. Thank you. Again, the most important words which I would like to share with you, because I also take care of myself. I do not go outside until there is some emergency. So we should stay at home and keep ourselves safe, because our life is very important and there is no other options we have. So if we go outside, we will invite some problem. So better to stay at home for certain days, and we will overcome on this critical problem which is right now in front of us. So please stay at home, stay safe. Good night. See you again. Bye.